Moneycontrol. Today we are going to talk about SBI. Adani Group events has stolen the limelight from SBI that reported robust earnings in Q3 FY23. Before getting into Adani bit, let us briefly discuss the quarterly performance of SBI. SBI reported its highest ever quarterly profit in Q3 FY23, driven by strong loan growth, margin expansion and lower credit cost. The profit growth was also boosted by treasury gains during the quarter. SBI's loan growth improved to 18% YOY as of December end and was driven by both retail lending as well as the corporate credit growth. For the banking system as a whole, corporate credit growth has been muted in the past 7 to 8 years in absence of private investment and due to deleveraging done by the corporates. This is going to change in the coming future. The massive rise in the government's capital spending as proposed by the union budget will lead to revival of the capex cycle and boost SBI's credit growth in the coming years. SBI's margin saw expansion during the quarter and margins is likely to remain steady, which will be supported by the rising interest rate scenario. In terms of asset quality, SBI's asset quality cycle, which had turned favorable in the past couple of years, showed further improvement with both gross as well as net NPA ratio trending downwards. Slippages ratio also declined and credit cost also reduced during the quarter. The bank's provision coverage ratio stood at a healthy level of about 75%. Now talking about the legacy book, the legacy corporate stress accounts are well identified and are provided for. In terms of restructured book, that is contained at 0.8% of its total loan book, and special mention accounts also declined during the quarter and is contained to below 0.2% of its loan book, indicating a less asset quality pain in the coming future. That said, SBI has Adani Group exposure, which is around 0.9% of its total loan book, translating to around 27,000 crore on a loan book of around 30 lakh crore. Management has clarified that these loans are against the operating assets and against the projects that have been completed and are generating cash flows. There is no loan solely against the pledged securities, and the bank has adequate collateral. Having said that, investors will always be concerned about the exposure. How should investors view this data point? Some investors will consider Adani exposure as a concern area, while other investors would consider it as a tricky situation, but which may not eventually lead to credit or a default risk. Long-term investors would be better off looking at the valuation of the bank. That would serve as a compass and show the right direction amid lot of noise. Talking about the valuation, the bank's valuation is currently around 0.9 times core book value estimated for FY24, adjusting for its subsidiaries. The valuation is very attractive considering that return on asset has improved to about 1% and return on equity has also inched above 15% in the current quarter. The bank's current valuation is pricing in lot of concerns, and the investors buying the stock at the current price would get its valuable subsidiaries almost free. However, the stock is likely to remain volatile in the near to medium term, and long-term investors can utilize this volatility to accumulate the stock.